Hi, I'm Lance Roberts from Clarity Financial and, of course, our editor at realinvestmentadvice.com with today's Technically Speaking update for Tuesday, October the 9th. The interesting thing here is that there's been a lot of angst in the markets really over the last few days because interest rates have been moving higher. And that really causes two issues with portfolios in particular. And I want to kind of address a couple of issues and concerns that we've been addressed and asked about from clients. And I wanted to cover that with you a bit today. First of all, let's talk about where the markets are and what we're currently doing, or at least thinking about doing here in the short term. We talked about in the newsletter over the last couple of weeks that expect volatility in the month of October. Why? Because, well, we had a very strong August and September, and so not surprisingly, we're getting a little bit of volatility pickup here in the month of October. As markets had gotten very overbought back in September, we needed to have a healthy correction here in order to work off some of that overbought status. Now, that sets us up potentially, again, our target for the end of the year remains 3,000 currently on the S&P 500. From current levels, that's about a 3.5% advance roughly from where we are today. As long as we maintain support. Now, this is the key issue here, is that the markets need to maintain this support from January highs. When we broke out here, we had established a new high and a continuation of the bullish trend that ran really all the way back to 2015, 2016. Currently, the markets are holding that support today. But again, what happens today really isn't important. The most important thing is what happens by the end of the week. So as you know, we work in terms of portfolio management as to what happens at the end of the week. As long as we maintain this support, we've got a rally that could potentially move us higher through this end of this year as we move into our seasonally strong period of the year. Again, earnings and economic outlooks right now remain very good in the short term. Now, that's going to become a much different story once we move into 2019. But for the next couple of months, the economy and earnings remain supportive of the markets. And as long as we can get this rally and move higher here and get back above this trend line, the bull market will continue on. The risk currently, and we're watching this very carefully, we are oversold, which suggests that we'll get a rally in the short term. A rally that fails at the bottom of this uptrend line that runs all the way back to April of this year would theoretically set into motion a more important topping process. This is called a head and shoulders process. Here was your left shoulder back in early September, your head in late September. We're now forming potentially this right shoulder in the markets. Now, that is a concern because, again, if we break this level of support, we're going to have a bigger decline, probably back around to 2,750 to 2,800. Again, that's not a massive decline from here. It's 2-3% at the most likely. And then that would set us up again for a rally into the end of the year. So we are watching this pattern closely. We're not making big equity changes at this point, but we are aware of this. So on this rally that we are expecting here over the next few days, that works this oversold condition back off again, we'll look at potentially rebalancing risk in portfolio, maybe even adding some hedges. Now, what's been causing all this angst? Well, that's been rising interest rates. Here's the problem with portfolios currently. While the equity side of the portfolio has been doing very well ever since the April lows, and we've been making gains in those positions, the problem is that rising interest rates here above 3% have depreciated the price of bonds. And of course, with bonds, as the price goes down, as interest rates move up, there's an inverse relationship that drags on the performance of a balanced allocated portfolio. So in other words, while equities are rising on one side of the ledger, bonds are going down on the other side of the ledger, which is reducing the overall net return of the portfolio. This is one thing that individuals tend to forget about when they own individual bonds, which is simply that when the bond matures, it matures at face value. If you own a bond and interest rates move up dramatically, the price of the bond will fall. But when the bond matures at face value, it matures at 100% of its face value. So in other words, despite the rise in interest rates, all the principal comes back to you once the bond matures. So in the short term, you may see some price suppression in your bonds, but just remember that longer term, the value of that comes back. And the real value of bonds in a portfolio is that they not only protect principal by maturing at face value, they also provide the income stream from the interest rate. So the thing to really look at in your portfolio is to separate out the equity performance of the portfolio from the bond performance and realize that the bonds, when they mature at face value, give you your money back, protect your principal. That's the value of fixed income within a portfolio. It also reduces the overall volatility of the market by having that issue. Now, normally, when stocks begin to stumble, we see money rotate from stocks into the safety of bonds in the market. This provides some offset with the markets. However, since the beginning of this year, because of concerns over rising inflationary pressure, stronger economic growth, etc., there's been an angst that with the Fed raising interest rates, that interest rates across the entire bond spectrum are going to continue to rise really indefinitely. The reality, though, is that we are to the point where interest rates are already beginning to impact the economy. This is what I was saying at the beginning of next year. You're going to see those interest rates really starting to affect the economic environment as well as the earnings environment for equities. That's going to really provide an opportunity for bonds to shine. So as interest rates remain here above 3.2% in that area, in that range, we're going to be looking to add bonds to portfolios, because from a contrarian investment point, bond traders are net short bonds at the greatest level in history. If you didn't read our last weekend's newsletter, I encourage you to do it, because we went through the entire spectrum of what's happening with bonds and why there's a real opportunity for adding bonds to a portfolio right now, because that's where money is most likely going to be made next year, even more so than what will be made out of selected equities. That's today's market technical update. I hope you'll read it in full and let me know if you have any questions. Simply go by the website, realinvestmentadvice.com. I'm your host, Lance Roberts. Love to talk to you. Love to answer your questions. realinvestmentadvice.com.